What's up everybody, Genix Dividend Investor here. In this video I explain ways to find what the best dividend stocks are to help you become a better investor. I'll end this video with some special shoutouts, so I encourage you to watch the whole thing. But first I gotta state the obvious, which is that best is often in the eyes of the beholder, so don't get triggered if your version of best is different than mine. I mean, it's kinda like asking what's better, blondes or brunettes. I'd say blondes, but my wife is a brunette who dyes her hair blonde, so I'm not sure what that means other than maybe I get the best of both worlds. The real point is that for some people, best might be a stock that yields the most total returns, or it might be one that provides the most dividend income, or it might be one that has had decades of consecutive years of strong dividend growth, and that is expected to continue doing well into the future. Whatever it is, don't get hung up on the word best, and instead just hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Okay, to begin with, the best dividend stocks tend to be ones from large, well-established companies that have a rich history of good performance that you believe will continue to flourish into the future. I say tend to be because there are always edge case examples of great companies that might not fit the ideal mold of what a best dividend stock is. Maybe a smaller company is a great dividend payer, and they'll eventually grow large enough to be on the S&P 500. And in fact, about 80% of the companies in the S&P 500 pay dividends. These companies have regularly distributed a portion of their profits to their shareholders in the form of dividends, typically on a quarterly basis. What that means is that if you hold some shares of a dividend company, then every 3 months you'll get some cash deposited into your account just for being an owner. Some people take that cash and reinvest it, buying more fractional shares of itself, enabling what's called a compounding snowball. That makes it so that each payout you get leads to an even larger payout, and your growth happens faster and faster. Now, a common question people ask is why do people invest in dividend stocks, so I'll tell you multiple reasons why they do, all of which will help identify how to find the best dividend stocks. So the first reason why many people invest in dividend stocks is to create a steady stream of growing passive income. I mean, one of the core attractions for owning dividend stocks is because they can provide truly passive income flowing into your account without you needing to sell any shares of stock. It's pretty powerful to have another income stream coming into you without you having to spend time working for it, and having multiple streams of income coming in that aren't tied to you needing to do anything for them is how you can retire early, or at least retire better. Another nice aspect of dividend stocks is that once you buy them, you really don't need to know much or do much for them to keep paying, kind of like the interest you get in your bank account, only dividend returns are usually way better than bank account returns. That being said, I'm not advocating for ignoring your companies. Bottom line, I'm confident that my dividend income will keep trending up over time, with some setbacks here and there, and even when I'm gone, my dividends will keep providing for my wife and kids, and hopefully their kids if they ever have any. I hope my portfolio becomes a core part of the financial foundation for my kids and beyond, and there's no reason why that won't happen unless my offspring succumb to selling stocks for a quick buck rather than continuing to hold and ideally reinvest a portion. And again, some of my companies will fail, but I also own some dividend ETFs which should stay relevant over time even when my individual stocks croak. And ultimately, if you don't figure out how to make money while you sleep, then you'll have to work until you die. And in the vein of dividend income being passive is the fact that many dividend investors are also quite passive when it comes to buying and selling stocks. What I mean is that we tend to buy and hold rather than trade, and that also means that we tend not to stress when the stock market is crashing because we're happy to keep collecting divvies while we wait out the storm. The reality is that good dividend companies keep paying divvies as long as their products and services are being purchased around the world, and the amount of dividends you get paid isn't tied to the price of a stock. So a stock price cratering can mean an opportunity to buy something when it's cheaper, thus something to celebrate, not fear. And because having a steady stream of passive income is a big reason why people invest in dividend stocks, then one of the key things people look for when identifying a great dividend stock is one that has a great track record of increasing dividend payments. Of course, just because a company has a good track record in the past doesn't necessarily mean they'll have a good one in the future, but history often is a helpful data point to consider. Now, an awesome and free up-to-date resource I've found to identify dividend stocks with 50+ consecutive years of increasing dividend payments is the Dividend King spreadsheet accessible on SureDividend.com. I'm not affiliated with SureDividend, but they provide some valuable stuff, so I'll include a link to them in the description of this video. I made a copy of their King spreadsheet and I tweaked the data some, adding some new columns in and formatting it a bit for this video, and this is the first page of tickers they have, sorted by most consecutive years of dividend increases up top. And while many decades of consecutive dividend increases is a sign of a potentially great dividend stock, there are companies that were dividend kings at one time and then fell off, and some of the companies on here might not meet all your criteria for what a best dividend stock should be. Anyway, the company with the most consecutive years of dividend increases is American States Water, ticker AWR, who just last month did an increase which marked their 70th year in a row of dividend hikes, a new record in the world as far as I know. Pause for a moment and reflect on how amazing that is for a company to have paid and increased their dividend for 70 years in a row. Truly incredible. AWR is a water utility, currently at a 2.2% dividend yield, which is a tad low, but they have a nice 5-year annualized dividend growth rate of 7.1% and are at a solid 6% payout ratio. One criteria some people use to help identify great dividend stocks is by adding up a company's current dividend yield percentage to its dividend CAGR percentage, and if it's over a certain amount, maybe 10% or 12% or whatever you think makes sense, then it becomes a candidate for being an awesome stock. Looking through this list, I see that Altria makes that cut, with its 16.6% total across those two metrics, and it's a company I own. Altria has its baggage, and its forward growth has some real risks, but also has some potential, and historically has been one of the best dividend stocks out there, but whether it will be going forward is a good question. Tobacco stocks are known for giving you more dividend yield, but they obviously have risks of increasing regulations and declining smoking rates, broadly speaking. So you gotta be aware that higher dividend yields can mean more risk. Is it because the company is struggling and its stock price has fallen, pushing its yield up? Or are all yields in that type of ticker simply higher on average? You want to understand why a company's metrics are what they are, and then you can use that to identify stocks that operate as outliers, bucking the trends in a good way, which is a sign that it could be one of the best dividend stocks. And note, it's okay if your version of best stocks has greater emphasis on dividend growth versus stock appreciation versus yield or whatever. There's some amazing dividend stocks out there. Like Costco has 19 consecutive years of dividend increases, so it's not a king, and it has a super small 0.52% yield, but it has a great 5-year dividend CAGR of almost 18%, along with a super low payout ratio of 26%. And if we look at its total returns, we see that its 1-year, 5-year, 10-year, and longer time frames all have blown the SP 500 out of the water. So if your version of best is total returns, then Costco fits the bill. And it's officially a dividend stock, but clearly its dividend isn't what's generating most of its returns, unlike Altria these days. Thus, invest in a way that enables your goals, and if you aren't sure what your goals should be, then aim for what will enable the best total returns. Something else to be aware of is the dividend payout ratio, because as payout ratios get too high, then that often means the dividend might be getting harder to cover, generally speaking, and a great dividend stock has to be able to pay its dividends. Some categories of dividend stocks like REITs don't use the classic payout ratio, and some companies might be in industries where their payout ratios run hotter than the norm. So like whereas something around or under a 65% payout ratio is generally what you want to aim for, some sin stocks are comfortable running in the high 70s. Anyway, as I glance through this King's list, I see multiple companies I own, including Procter & Gamble, Colgate-Palmolive, Johnson & Johnson, Coca-Cola, AbbVie, Kimberly-Clark, and Pepsi, all of which I'd count as some of the best dividend stocks out there. Another helpful source you can use to identify SP 500 dividend stocks with 25 plus consecutive years is the Dividend Aristocrats list on the Wikipedia. Okay, so we talked about how we can find companies that have a good track record of divvy growth, historically speaking, but how do we gain confidence that their futures will continue to enable good dividend growth? Well, that's where your research needs to come in to understand a company, its competitors, its likelihood to continue to grow, etc. One tool I like to use to help me estimate a company's future growth is fast graphs, and here it shows us that American States Water is estimated to have a go-forward earnings growth rate of 7.28%. That gives me some degree of confidence that the stock should perform well in the future, a future which should include its ability to continue hiking its dividend. Of course, forecasts are just estimates, so you can't assume that it's going to be perfectly accurate, but a lot of investing is about probabilities and confidence levels and such, so while I know forecasts like these won't always be correct, I do like what I see. And I use tools like this to help me save time, but you should do whatever works for you. Okay, another reason the best dividend stocks tend to have good dividend growth is so that they can outpace inflation. Basically, you want your buying power to continually grow, even if you aren't reinvesting your dividends, so divvies ideally should average a higher hike percentage than inflation averages as time goes on. Sometimes inflation might be higher, like the extreme levels we recently had, but overall the best dividend stocks outpace inflation. And watching your dividends continue to grow on their own is awesome to experience. Plus, history has shown us that dividends are often your only source of return when the stock market goes sideways or down, and having a return when the rest of the market is on fire can be quite motivating, and the motivational aspects are another reason why some people invest in dividend stocks. I mean, it's really cool to continually see your share count growing and your dividend income growing, and that motivation can help keep you in the investing game even during decades where the market is performing poorly as a whole. Of course, you need to guard against chasing risky income that isn't sustainable, which ties back to why the best dividend stocks are ones you should focus on. Okay, now let's move on to another reason as to why people choose to invest in dividend stocks, and that's to enable good total returns that can compound over time. In my experience, the best dividend stocks not only have good dividend growth histories, but they also have good stock appreciation. And since stock prices tend to follow earnings, then our future stock price appreciation estimates can also come from our future earnings growth estimates that we either calculate or leverage from a tool. Now you can just Google a ticker to see how it's performed, but if you also want to see how dividends have contributed to total returns, then you can either use a free tool like Portfolio Visualizer, or you can use the momentum graph on Seeking Alpha, or you can use the performance tool on FastGraphs. I used to like Portfolio Visualizer, but they recently updated their UI and I'm not as much of a fan anymore, so instead I'll jump into Seeking Alpha, and let's look at how American States Water has performed over time. Here we see a graph of total returns for American States Water in orange and the S&P 500 in blue over the last 25 years. I like to look over both long time frames and shorter time frames, as each can give me new insights into a company's performance. What's really surprising to me is that AWR has returned a total of 1,915% over those 25 years, which is almost triple what the S&P 500 returned at 683%. Wow. Note the free version of Seeking Alpha lets you see the last 5 years or less of returns, whereas the paid one lets you see multiple decades as well as lets you customize time frames. Okay, now let's check out what the last 5 years of AWR's returns look like, broken into stock price returns and total returns, where total returns includes reinvested dividends. And again, this is a wow for me, but for a different reason, because now AWR's returns look crappy as compared to its 25-year returns. Specifically on the top stock price returns graph, we see that AWR has lost 7% over the last 5 years as things have basically gone sideways and down a bit, whereas the S&P 500 has gone up around 87%. And when we look at total returns over the last 5 years, we see that AWR has returned only a 1.52% return, i.e. not negative anymore because its dividends have dragged it up, but it's still falling far behind the S&P 500's total returns. TLDR, in the last 5 years, AWR has performed terribly, but in the last 25 it did amazingly well. It's a great example of how one person's crappy stock could be another person's great stock. I mean, if you'd held it for over 25 years, you'd be quite happy, even if the last 5 years have been bad. It's kind of like holding Microsoft through the lost decade, because people who hung on to it until now have made out like bandits. And sure, if you sold it when it did nothing for 10 years and then bought back in, well, that would obviously be ideal, but ideal is rarely what happens in the stock market. Anyway, if I was serious about AWR, I'd want to dig into what was going on in the last 5 years. I mean, it's normal for stocks to go through periods where the market doesn't price them based on its intrinsic value, and so your job is to figure out what's going on. You gotta remember Warren Buffett's mentor, Ben Graham, who said, "In the short run, the market is a voting machine, but in the long run, it's a weighing machine," which emphasizes the difference between short-term market fluctuations and long-term fundamental value in investing. So in the short term, the market behaves like a voting machine, meaning stock prices reflect popular sentiment, emotions, and the collective opinions of investors. Stock prices are often driven by performance, news, hype, trends, fear, and greed. As a result, the market might irrationally overvalue or undervalue companies based on temporary factors. But in the long run, the market acts as a weighing machine where the true intrinsic value of a company is what ultimately matters. Over time, stock prices reflect the company's actual performance, earnings, cash flow, and fundamentals rather than temporary market sentiment. So the key learning is that while market prices can be unpredictable and influenced by investor psychology in the short term, a company's true value will be recognized over time as the market weighs the substance of its fundamentals. Therefore, long-term investors should focus on intrinsic value and not be swayed by short-term market noise or price movements. That concept is a fundamental principle of value investing, where investors seek to buy stocks at prices below their intrinsic value and hold them until the market reflects their true value or overvalues it, assuming you need to sell. And a great way to enable good returns is to buy something when it's cheap, and FastGraphs is a helpful tool I use to gauge that. I used to manually calculate discounted cash flows to help me determine if a stock was cheap or expensive, and I recommend you learn how to do that, but now I prefer to use a tool. Okay, this FastGraphs for American States Water visually tells me that it's a tad bit expensive right now, as its current black stock price point is slightly above its blue line, and the blue line represents how the market has historically valued the stock relative to its earnings. Plus, the current black stock price is higher than its orange line, and the orange line represents what its fair value should be, using Graham-Dodd formulas based on the type of stock it is. Another observation I have looking at this graph is that AWR runs hot and that it's consistently trended above its fair value orange line, so its blue line is probably a better indicator for whether it's expensive or not. Now, there are other things I'd look for before investing, and I'd never blindly buy just because a tool said something was cheap, but if I was going to invest, then these are prices I'd be fine to DCA into, though I'd probably refrain from lump summing into it until it was cheap, but that's just me. Moving on, another big reason people choose to invest in dividend stocks is due to the fact that they often have lower risk and tend to be more stable than the average public company out there, and a company's longevity usually means strong financial trends, all of which can be characteristics of the best dividend stocks. Conservative investors favor lower risk investments, especially in times of market volatility, and thus they tend to gravitate towards dividend stocks. And one measure of a stock's volatility is beta. A low beta, typically less than 1, indicates that a stock is less volatile than the broader market, meaning it tends to be more stable during market fluctuations. Many high-quality dividend stocks, especially those in industries like utilities, consumer staples, and healthcare, often have low beta values as their revenues are less cyclical. So think of companies like Pepsi and consumer staples, NextEra Energy and Utilities, and AbbVie and healthcare. That being said, I would encourage you to prioritize quality stocks, not just quality dividend stocks. Like, why ignore Amazon just because it doesn't pay a dividend? Sure, you can focus only on dividend stocks, like I do now, but I wouldn't fixate on dividends at the cost of missing out on great non-dividend companies unless you're in my boat. And it depends on your goals and personality and such. Maybe you're okay investing more defensively, and you recognize that you might make less in bull markets, but you'll also probably lose less in bear markets. Now, when I mentioned how the best dividend stocks have strong financial trends, I mean you want to see growing revenue, earnings, free cash flow, etc. Companies with strong cash flow are more likely to maintain or grow their dividends, and are more likely to see their stock appreciate. For example, take a look at this free cash flow to dividend graph of J&J's, one of my favorite healthcare dividend stocks. The green bars are free cash flow to equity per share versus the purple bars, which are dividends being paid out. You can see J&J's free cash flow easily covers its dividends, and everything is trending up, all of which I want to see in the best dividend stocks. Another facet to consider is risk, and the reason why J&J has faced some downward pressure lately is due to the financial risks it faces with its baby powder talc lawsuits in all 50 states. Now, lawsuits are quite common for every public company out there, and 9 times out of 10 they won't materially impact them, but every so often something comes along that might be too much for your comfort level, so you gotta decide what you want to do. I believe in J&J enough that I'll continue to hold, and in fact would be fine to DCA more in at today's prices, unless I'm comfortable with its risk profile, and I'd argue it's one of the best dividend stocks out there, though I'd also understand it might not be right for you. I've had people in my comments who freaked out at me owning Pepsi because of its sugary drinks and its potential for diabetes. I've had people freak out because I own tobacco stocks. And I've had people freak out lately that I own Starbucks and McDonald's because of boycotting and lots of other reasons. In the end, you gotta do you, and what's best for me can be different than what you're comfortable with. Anyway, beyond all that, you also want to dig into a company's debt situation. And when analyzing debt trends of a dividend stock, it's essential to ensure that the company can sustainably manage its debt while continuing to pay dividends. If the company is taking on debt faster than it can grow its revenues or profits, it could face financial strain, leading to dividend cuts. If you want to dive into debt more, then take a gander at a company's debt-to-equity ratio, which compares a company's total debt to its shareholders' equity, and which shows how much of the company's operations are funded by debt. A red flag is a debt-to-equity above 100%, as that would indicate that the company is heavily leveraged and may face challenges if interest rates rise or if earnings fall. You can also look at a company's interest coverage ratio, which measures how easily it can pay interest on its outstanding debt with its earnings before interest and taxes. If the interest coverage ratio falls below 1.5, the company may struggle to meet its debt obligations and maintain dividends in tough times. And obviously, you want to make sure that your company's business model has a competitive moat. For example, companies with dominant positions in their industries, like Coca-Cola or Johnson & Johnson, are better able to sustain their dividends as they're deeply entrenched with their consumer. Those types of companies tend to be rock solid, as it's hard for competitors to come in and replace them or displace them. Another good practice to do is to check a company's dividend safety from resources like SimplySafe Dividends or Morningstar's Dividend Safety Score to assess whether a company's dividend is sustainable. The best dividend stocks obviously have a sustainable dividend. Moving on, another reason why some choose to invest in dividend stocks is sometimes due to their tax advantages, as dividends may be taxed at a lower rate than ordinary income, making them an attractive option for investors seeking tax-efficient income streams. I did an entire video called Dividends and Taxes, the Good, the Bad, and the Ugly, if you're interested in understanding the various aspects of dividend taxation. One of the TLDRs from that video is that now that I'm retired, my wife and I can make $123,000 of qualified dividends in my taxable brokerage account and owe $0 in federal income taxes. That is a massive tax benefit and is part of why I value blue chip dividend stocks so much. I mean, being able to make that much tax-free income, at least in my situation, are aspects why my tickers are the best dividend stocks for me. Now, some dividend haters say that taxes are one of the reasons they don't like dividend stocks. Like they would rather control when they take gains on a stock by selling when they need to sell, not being forced to take a dividend and thus being forced to have potentially taxable income. So again, the best stock for you depends on ones that enable your needs, goals, desired timeframes, and risk tolerances. Each ticker ultimately should play a role in your overall portfolio, and what's best for me might not be what's best for you. Like most classic dividend investors wouldn't say that Microsoft is one of the best dividend stocks. I mean, its yield is under 1% these days, which probably won't cut it for people wanting that dividend income. But I'd argue it actually is one of the best dividend stocks out there, depending on your needs. For example, part of my goals with my portfolio is to hold tickers that enable alpha, and even though I'm retired and living on dividends, Microsoft checks that box when you look at both historical returns and its future expected growth rates. Its yield is super low, but its 5-year annualized dividend CAGR growth rate is over 10%, so it hits that mark of 11% when you add its current yield along with its dividend CAGR. I also want my portfolio to roughly have the same sector coverage and weighting as the market, and Microsoft contributes to that technology ownership I desire. And when we look at Microsoft's dividend grade on Seeking Alpha, I see that it rates its dividend safety an A+, its dividend growth an A+, its yield a D, and its consistency an A, and all of those marks seem accurate and appropriate to me. And in fact, literally as I was working on this section of the video, someone on my Dividend Discord shared that Microsoft just increased their dividend by over 10%. I always run polls on my Twitter account where my followers can guess how much my companies will raise their dividends by each year before they announce their hike, and this time the highest percentage of answers correctly guessed that Microsoft would raise their divvy between 9 to 12%. This hike became Microsoft's 20th consecutive year of dividend increases, showing me their commitment to strong dividend growth at a level beyond inflation, both things which I like to see. And note, over the past year, the average dividend growth rate for companies in the S&P 500, excluding special dividends, has been about 6% according to FactSet. Microsoft's new dividend should cost them about $25 billion a year in payouts to shareholders like me. That might seem like a lot, and it is, but Wall Street projects 2025 free cash flow of over $80 billion for Microsoft, and they have very little debt on their balance sheet, so they're easily covered. In fact, their ample cash flow is why they also authorized another $60 billion in buybacks, which will act as further upward pressure on their stock price, as that's about 2% of their shares outstanding at current levels. Microsoft is probably my favorite company in the world, given what they've accomplished and how diverse their revenue categories are, and how highly I think about their future potential. I mean, they dominate in the gaming segment with their Xbox and other stuff, and they're still crushing it in the PC operating system space with Windows, along with their various software packages, and their cloud platform Azure is growing like crazy, and their investment in OpenAI looks to be spectacular, amongst other things. I'm confident that AI will indeed live up to the hype and beyond, and I think its impact to society will be as big as the internet turned out to be, and awesome companies like Microsoft will end up benefiting from where things go. For reference, I have 374 shares of Microsoft, and now they yield me $310 a quarter, up from $280 a quarter before their recent hike. Microsoft is my 5th largest position of the 28 tickers I own, and I have 163 grand of it. If you look at Microsoft's revenue trends, earnings trends, cash flow trends, shares outstanding trends, dividend metrics, etc., it's an absolutely best-of-breed company in stock, at least for my needs. So even with dividend income being a key goal of mine, one that Microsoft hardly contributes to, in the long run it has enabled lots of my goals, and in fact it appreciates so much that every so often I can trim some of it and build other positions. Like when I finally got to the point that my dividend income covered my expenses, I retired, and I trimmed some of my Microsoft and Apple profits to invest them into higher yielding things, including some income dividend ETFs. It's pretty cool to be up a ton on a ticker and then use a portion of its profits to subsidize income ETFs in a way that still remains conservative overall in your portfolio, yet also gasses your income. Another reason I have Microsoft in my portfolio, and another reason why it's one of the best dividend stocks, is because it also acts as a safety net. Like if a ticker of mine cut its divvy and I needed more income, I know I could go to my Microsoft position and trim some of it and exchange it into higher yield stuff to enable my overall income needs. That being said, I'd encourage people to avoid selling their winners, but I'm probably in a different situation than you are. Like case in point, I was looking at my son's custodial brokerage account the other day, and he has Microsoft in it, and I wouldn't want him to sell any of it at this stage of his life. Different goals make sense for different folks, and what's best for me isn't necessarily what's best for you, and that goes back to why best can be a subjective term. I like to own a mix of yield stocks, and those that grow more, and stocks from multiple sectors, and stocks that gain revenue internationally, etc. Focusing on yield for a moment, I see that 18% of my tickers were under a 2% dividend yield, 65% yield between 2 and 5%, and the remaining 17% or so yield more than 5%. Yield is just one facet of many things I consider for my dividend portfolio, but it's something people focus on, so I thought I'd share that breakdown. Bottom line, instead of me telling you what the best dividend stocks are, I instead wanted to paint the picture of the types of characteristics that make a great divvy stock so that you can craft a portfolio that meets your needs and is best for you. I prefer dividend stocks from large US companies that have done well in the past and that I think will continue doing well into the future. But there are great non-US stocks that are worth considering as long as you understand the trade-offs. Like Canadian banks are generally famous for being strong dividend stocks, but us US folks also have great financial brands at home with companies including JP Morgan Chase and Goldman Sachs amongst others. The reality is that there are great dividend companies all around the world, so you've got to figure out what makes sense for you. And you don't need to own every awesome stock. I mean, I find it challenging to own and stay abreast of more than 30 or so tickers, and I'm comfortable with my current 28. But someday I might finally get into awesome divvy stocks like Visa or Costco or Waste Management or Walmart or whatever. There's lots of incredible dividend stocks out there. Please leave me a comment telling me if there are any dividend stocks that you want to own, but you haven't gotten around to buying quite yet. And with that, I'll ask that if you got any value from this video, then I'd really appreciate it if you hit the thumbs up button, subscribe if you haven't yet, and click that bell notification, as all that really helps my videos. Okay, now I'd like to do some fun shoutouts. The first one goes out to Stephen Y, who recently signed up as a Patreon aristocrat. Next, I'd like to shout out Chris J, who upgraded from a champion to a king. Kings give you everything aristocrats and champions get, and they can chat with me for 30 minutes each month in a private voice chat on my Dividend Discord, as long as they remain a king. I'm not a professional, but I'm happy to chat about whatever folks want. I also want to shout out David, who just did a thank you donation of $9.99 to support my channel, which is very cool. And I'd like to shout out Mike Hang, who just clicked that join button to become my latest channel member. Channel members get a badge icon that is placed by their comments on my videos and which levels up over time as long as they remain a member. So like Brett, Jeff, Truth, and Lance all hit the 6-month mark, so they get a silver badge star icon. Scott, Steve, and Lance again because he's OG, David, Ewa, Keithman, Max Roeder, and my new member Mike all get the red star badge icon. And in case you're wondering, after silver is a gold star icon, then a red crown, then a silver crown, and then a gold crown. Channel members also get the ability to vote on which thumbnails I use for my next video, and they get to watch my videos before I release them publicly. I also do things like share some pictures privately with them, plus I give my channel member comments priority when I'm replying, and while right now I can handle responding to everyone's comment, I'm guessing at some point I'll need to scale back. Overall, channel members get some fun perks for $5 a month, and it's something people requested I do since my Patreon Aristocrat and King seats are normally sold out. Now I'd like to recommend that everyone check out my FastGraphs affiliate link along with my coupon code in the description of this video, as using both should allow new users to get 25% off the first payment even if they sign up for a full year. I'll also recommend that you try out my Seeking Alpha affiliate link, as new users can often get good discounts for signing up. Plus, take a look at my Patreon seats to see if there's any you want to sign up for, but since my Patreon Aristocrat and King seats are usually sold out, I'll also recommend that you join my channel membership, which gives you a variety of perks you'd probably like. And don't forget to join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 83 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.